And again, apologies, everybody. Technology never works when you need it the most. I was just mentioning, just looking at history, leaning on history. One of the things Mark Twain famously said is that history doesn't repeat, but it often rhymes. So we certainly like to look at history, and I just mentioned some of the worst days we've had in the marketplace over the years. And certainly we've had 3 of the worst 15 days. And we just looked 1 year later, and the market's up over 24% 1 year following some of these worst days. So hopefully a hopeful sign leading on history. We certainly like to do that. Let's switch gears a little bit and talk about the psychology of investing, and just give you a little taste of what we mean by that. It's really about the emotions. Emotional investing and how your emotions impact your investing decisions. And this has gotten a lot of attention historically from the industry, from the academic side. It's called behavioral finance from an academic side. We call it psychology of investing because psychology of investing means a little bit more to folks, and they understand it a little bit better what that means. But it has gained some attention. I mentioned on the academic side, Richard Thaler from the University of Chicago won the Economic Nobel Prize for his work with behavioral economics in 2017, and certainly you've seen it other places as well, like Michael Lewis, the author of Moneyball, one of my favorite baseball books, or The Blind Side. That author, one of his recent books is entitled The Undoing Project, which is about 2 of the behavioral economists that did some of the original work on this. So a lot of things that we can lean on here. One of the things we like to do is just look at one of the examples of what behavioral finance is. And this is an example that looks at 4 different investment choices and just asks the question, which one would you choose going forward? Just knowing what you know, looking at the slide, would you take the red, the volatile line? Would you take the pink, which is second best but very straight and seems orderly? Or the green, which is somewhat volatile, and green is volatile and ends up in 3rd place, and then the yellow choice, which is 4th, but clearly the lowest option on the board. When I do this live with audiences and have them raise hands, 90% of the folks take the pink and the purple line, and very few folks take the red. There's a handful. Couple people take the green. Nobody takes the yellow. And this is what our minds try to battle, right? We try to battle that risk-reward scenario in our investment decisions, and this is the emotions that really drive our decisions. But look what happens to these investments as we step through in time. These were actually real live investments. Red was Pfizer, very volatile line. Green was the U.S. stock market. Yellow was U.S. T-bills, and pink was Fairfield Century, which didn't end up too well, ended up actually at 0. Fairfield Century, most folks don't know what it was. It was actually the Bernie Madoff feeder fund, which obviously was too good to be true. So this is an extreme example, but a taste of what we mean by behavioral finance or the psychology of investing. Our brains were naturally drawn to that pink line because we're trying to maximize reward and minimize risk. And that pink line seems to do it. Gets a second best from an overall outcome, but does so in a very predictable, orderly fashion, as I mentioned. But obviously that was too good to be true. But this is what the psychology of investing is all about, understanding how our emotions impact our investment decisions, how that battle between risk and reward works out in our minds. And one of the keys that we talk to folks about is how key this is to successful investing. You look at it, you could be the best stock picker. You could have the best advisor from building a portfolio standpoint. You could work with the best tax planner. But if you don't have the right investor behavior, then everything falls apart, right? If you're not into the market at the right times or for a long enough time period, if your emotions drive you out of the market, if you have bad investor behavior, your investment plan falls apart. And that's what we try to get after with this topic, is really understanding and trying to improve that investor behavior, make sure our investment plan stays on the rails and does not deviate because our emotions get the best of us. So what I'll do the rest of the way, we'll just talk about the highlights here, really talk about two of the extreme emotions, what we call envy, and then on the other side, loss, and then finally just building in discipline. Let's first talk about that envy or greed scenario, and we'll talk about a non-financial example here. This is in regard to the Olympics. We all know the Olympics well, and this is actually a study that's been done quite a bit over the years every time the Olympics come around. And you can see the story here. It's all about the happiness of the medal winners. Believe it or not, people actually study that. But you can see here that the medal winners here, of course, the gold medal winner is always the happiest, no question about that. But they actually looked at the reality that the bronze medal winner is almost twice as happy as the silver medal winner. And I think we all can figure out why this is. The bronze medal winner is just happy to medal, right? They were probably just as close to not medaling at all, not being on the podium at all, versus the silver medalist is probably has some regret, has some envy that they just missed out on the gold. And we see this consistently when they've done these studies with the Olympics, is that silver medalist is kind of caught in between and regrets that they finished in second place, where the bronze medal winner is just happy to be on the podium. And think about this in a lot of our decisions in life. If we were rational humans, we'd only regret bad decisions or bad outcomes. And oftentimes we regret what could have been. The old fear of missing out, or the millennials call it FOMO. And this is a natural reality that we have as human beings, right? We regret better outcomes. And you can think about this with your investment plans. It happens consistently with investing. We always joke that a well-diversified portfolio never feels good. So if you have that feeling of regret and envy with your portfolio, that's a natural emotion that we have, and we actually call it S&P Envy. We actually gave it a name, and this slide just looks at that reality over time. That when your portfolio is in a difficult market like we've seen recently, you still lose money. And certainly we've had some significant bear markets, this one currently certainly included in that. But on this slide, we look at the technology bubble bursting. A diversified portfolio of 60% stocks, 40% bonds was still down 18%, almost 19%. And 2008, it was down 24%, one of the worst years ever for a diversified portfolio. That never feels good, right? You can't hide being down 24% on a statement. Certainly that kind of loss can stir some emotions, especially that loss emotion. And then when the market's up, you can see what happens as well, that you're not up as much as the overall U.S. stock market or the S&P 500. And this is certainly a challenge because you can see the behavioral reality here. And you can see my emojis there. But you get the simple dynamic that you still lose money in a difficult market, and then you don't make as much coming out. So you lose money trail, creates a very tough behavioral dynamic. Very tough to see why a diversified portfolio makes a lot of sense. Especially look at that last 11 years leading up to this crisis, ending in 2019. The diversified portfolio trailed the U.S. stock market by 160%. 160% that you left on the table. This is natural for this regret emotion to say, wow, I wish I would have had more in U.S. stocks. And that's a natural emotion, but it ignores the fact of why we build portfolios the way we do, which is if you actually add up all these different time periods, the diversified portfolio actually ends up ahead. and it does so with obviously less risk, less drawdown, less volatility. But we think this is a great reminder, even in a difficult market. We certainly designed this more for that 11-year period when you trailed U.S. stocks by 160%. But I think even realize that even in a difficult market, losing money is always painful. Certainly have some regret around that. But if we can minimize those losses and get a good chunk of that upside of what the bull market delivers when it returns, you can win more by losing less. And we say that quite a bit at BlackRock, win more by losing less. And that's what we look at on this slide, is that a well-diversified portfolio never feels good. And it's because of this dynamic. And this is why we build portfolios the way we do, though. If we can minimize those down periods, we can win more by losing less. So that regret emotion is very difficult in a good market, and it's all about the math. This next slide just talks about the math, and they probably tell you never to do math on a conference call or a webinar, but we'll give it a shot here. If you lose 50% in year one, what do you have to be up the next year just to get back to break even? You have to be up 100% to get back to break even. And I think folks can follow that in the gray box up top. Look what happens if you're only down 10% on the bottom, though. If you're down 10%, you have to be up 11% to get back to break even. And you can see as we build into this table, the deeper you get into that loss territory, the more the math works against you, right? If down 20%, you have to be up 25, down 50, up 100, as we mentioned. Look at the minus 50 to minus 60. You have to be up 150% just to get back to break even. That's what we're trying to minimize when we build a portfolio the way we do. If we can minimize those bear market losses, we can win more by losing less. And that's really a valuable reminder, we think, at this point of the cycle. That regret emotion is natural. We all have it, right? A diversified portfolio is always the silver medalist, if you will. But it works over time when you actually zoom out and look at the bigger picture. Now let's switch gears a little bit and talk about that loss emotion. Obviously something we're all feeling right now with the market. And one of the fundamental tenets of behavioral finance work is the fact that losses feel twice as bad as gains feel good. So I think we can all relate to that, right? Losses always seem to feel worse than gains feel good, and that's one of the first things the academics found. One of the other things they found was that when things are broken or we think there's a problem, as humans we naturally like to take action to resolve those. We think the only value that can be provided is actually taking action to something. And this is another famous study, non-financial related, but looks at soccer or football as they call it in Europe, and it just looks at the penalty kick, which is the goalie against the kicker, often decides matches and games and sometimes World Cups, where it's just the kicker and the goalie one-on-one. I think the distance is about 12 yards away. The goal's 14 feet wide, and the goalie has no chance here, right? If the ball is struck properly, the goalie doesn't have time to react. So the question that these studies looked into is what's the best thing for the goalie to do? Or what's the best thing for the kicker to do? And what they found was that most of the time the goalies actually jump right or left 94% of the time, right? They just have to make a guess and try to anticipate where the ball will be going. And they usually jump left or right 94% of the time because they don't want to let their teammates down. They don't want to look like they choked and just froze in the middle. So they decide on a direction and they jump left or right. Clearly, the best thing to do for the kicker, and they found this in the study, is to kick it high center. If you kick it high center, you score 80% of the time because the goalie will never be there. But it highlights a natural human emotion that we have, which is the tendency towards action, especially during periods of time of stress, anxiety, like the penalty kick to decide the match. Our our tendency towards actions even more revved up in those scenarios. During periods of loss, right? It's just natural that we'll take action. And we see this all the time with portfolios and investing. You get periods of loss where that loss emotion's revved up. It's natural to think that taking action is the best thing to do. But when you look at history again and lean on history, you can see that oftentimes is the worst thing you can do with your portfolio. This is a famous study that every financial firm has. Looks at had you invested $100,000 over the last 20 years, it would have grown to over $324,000 had you stayed invested that entire time. And that's not too shabby historically, not the greatest period ever, but not terrible considering you have a couple big bear markets in there. But they just looked at the reality. What happens to this outcome, this $324,000, if you just miss the 5 best trading days? Look what happens to your outcome. You forfeit over $100,000 just missing a week of the best trading days over this 20-year stretch. And there's about 250 trading days in the year. And so just missing 5 of those days, so 20 years, 250 trading days in a year, that's about 5,000 trading days. Missing the 5 best hurts you that much. Look what happens as we move out to 15 and 25 days. You miss the best 25 days, which is a little bit more than a month of those trading days. You actually lost money over this 20-year stretch. And this is what we want to avoid, right? If that action bias gets the best of us, gets the best of our emotions, if that loss emotion is revved up because of all the volatility in the market and the fear of the virus, it's very easy to lose some of these best days in the market. We actually looked at we looked at the worst 25 days over this stretch, so just over the last 20 years, the worst 25 trading days. And certainly we've had a bunch here lately, as we talked about at the beginning of the call. But what naturally happens is that in 24 out of those 25 worst trading days, they were surrounded by the 25 best trading days. So think about that. The market naturally moves like a pendulum in one direction in a big way. It'll swing back in the other direction to a similar amount. And we've certainly lived that here the last couple of days, the last couple of weeks, where the market will have a good day, then it'll bounce the other direction and fall quite a bit. Obviously, we've had a little more falling than going up. But some of these best days are actually in some of the most volatile periods. So if that loss emotion gets the best of you and you decide to change plans, take some money out of the market, that can cause you to lose and miss out on some of these best days in the marketplace. So just a good reminder of what we try to do when we try to stay in the market and not try to time the market. One other last thing here on the loss or fear side is a famous quote from Warren Buffett. I'm sure we've all heard it over time, but I think it's a good one to think about right now in today's market. He famously said, "Be fearful when others are greedy, and be greedy when others are fearful." We call this a contrarian mindset, just thinking opposite of what most folks are thinking. That's one of the key tenets to being a good investor over time. And I think it's good to remind ourselves at this point of the cycle that reality. Be greedy when others are fearful. Last thing we'll talk about is just building in that discipline. I think one of the keys here to being a good disciplined investor is lean on your advisor. Let them be the emotional check and balance for your investor behavior. Actually, even at BlackRock, even some of the portfolio managers that are our best investors, we actually have behavioral coaches that help them with some of their challenges. Just to remind them that they might fall into some traps occasionally that eats into performance and outcomes. So we think this is so critical, and you have the advantage of working with a great team and use them when your emotions feel like they're getting revved up. Very easy to do. And we can see that on this next slide, and every firm, again, has this, just matching emotions to where we're at in the cycle. Feels like a roller coaster. And one thing that we've seen talking with advisors and investors across the globe, one of the best things to do is talk to your advisor about what your plan is when you get to that defeated stage of this cycle, right? When you get to that bottom of that roller coaster where you feel defeated, you feel that loss emotion at its peak, and have a plan. What are you going to do? Are you going to rebalance? Are you going to buy a little bit more? Actually talk about that plan consistently when you meet with your advisor, because when you do this consistently, you're actually doing so when emotions aren't as high. If you talk about, hey, what is our plan if the market does sell off 10, 20, 30%? And if you do that when you're very confident or maybe even overconfident with the market, it leads to a better conversation when you get to that defeated phase. Obviously, we're probably pretty close to that defeated phase now, but I still think it's good to have that conversation. Hey, what are we going to do if the market does continue to decline? Are we going to rebalance, buy more? What makes the most sense? And again, just consistently do that helps build in that discipline over time. Also, and this is so true today more than ever, is that discipline is challenged by the media, what we see on the television, all the financial news out there, all the access we have to information through the internet. We can probably pull up what the market's doing minute by minute on our smartphones. And if you look at the news today, more than ever, it's really designed to play on our emotions, right? It's especially getting to a period like this. The financial news it loves to play on our loss emotion and rev that up. I always comment on the CNBC is the big business channel from on cable news, and their two shows in the afternoon, if anyone knows and watches those shows, but they're entitled Fast Money and Mad Money. So think about that from an emotional standpoint. They're even titling the shows Fast Money and Mad Money because they know that hopefully that'll play a little bit on our emotions. Maybe that'll increase ratings, or on the internet, certainly everybody's looking for clicks and views. But that certainly does not help our discipline, is the fact that all this information we have access to today really plays on our emotions, and we need to make sure and be aware of that. And this is a famous study that we did looking at how often some of the Wall Street experts get predictions right, because naturally some of the sensational news that comes on these financial news networks is all about predicting, trying to crystal ball the future of the market or the economy. And one of the realities here is that just predicting the direction of interest rates, which is what this study looked at, they only got that right 43% of the time, where the coin flip actually did a little bit better. They got it right 50% of the time. So predictions are tough, especially about the future. One of my favorite sayings from that famous philosopher, Yogi Berra, from the New York Yankees: it's tough to make predictions, especially about the future. I love that. Again, I think we need to remind ourselves when we see some of these great predictions on TV from the financial news and even the news in general today. So I'm on a charts, believe it or not. Hopefully that was helpful. Think about where we started. Proper investor behavior is critical to investment success. You don't want your emotions changing your investor behavior, especially during times like this. Then everything else that you've done in your investment plan can really fall apart. And it's all about some of those natural traps that we have, right? Whether it's envy in a good market that we touched on. Remember some of the math lessons that we touched on, winning more by losing less. Or on the loss side, that losses feel twice as bad as gains feel good. And just trying to not time the market, but it's time in the market that makes the most sense. And of course, lean on your financial advisor. You have a great team here. Take advantage of them to be the check and balance on your investing emotions. And I think most importantly, be critical even when times are good, and be opportunistic when times seem bad. We're certainly seeing that right now. One of the most difficult things we see in investing is to take more of an opportunistic mindset when that loss emotion is so revved up. And we think that's how you become a better investor. It's a process. It's something that we all need to work on and remind ourselves, especially at this point of the cycle. And most importantly, save your emotions for the moments that really matter. Keep your emotions out of your investment decisions as much as possible, and save them for family and friends that really matter, especially in times like this. So, again, apologies. I want to apologize to the team for all the technology challenges. I really appreciate everybody hanging with us for this call. I know it lasted a lot longer than we planned, but hopefully good information that you can think about as we move forward here. So why don't I turn it back, see if there's any thoughts, comments from everybody.